If they take away the punch bowl a bit early, we can kind of deal with it because most people are sort of expecting it. A relatively normal cycle, I think people are fine with. My fear is the 2013 double pump. That's terrifying.
I mean, I see no value in it personally, so it probably goes back to like the 40s or 30s easily.
Because that was what, a 45% correction mid-bull market. Everybody thought it peaked because it already done 10x or 20x or 30x, whatever the stupid number was, and then it did like another 20x.
Bitcoin prices tumbled over the weekend after Iran's missile attack on Israel. This morning,
Bitcoin extending its losses this morning, trading just under $64,000 as of noon Eastern.
Crypto prices stabilizing this morning after tumbling through the weekend thanks to rising tensions in the Middle East.
Bitcoin started the week at 67,000, and after briefly touching 72 on Monday, it flash crashed all the way down to 65,000 in a few minutes and currently sits around 64,000. This choppy price action has been the summary of the story since the approval of the ETFs. After the run-up's post-approval, price action has been largely sideways. Considering this, many experts have speculated that this cycle will possibly be shorter than a traditional cycle, and that the impact of the ETFs will not be as significant as many have predicted. Some experts even went as far as explaining that irrespective of who is packaging the ETFs, the people buying are still largely retail, and they, like previous investors, will sell just as fast when things get hairy. After yesterday's flash crash and nearly $1 billion in liquidations, it's beginning to seem like perhaps there's some truth to it. But Real Vision founder and CEO Raoul Pal explains why this is not the case. Raoul explains that after the hurried end of the previous cycle, due to the FTX collapse and other black swan events, many investors have become traumatized and are much more willing to call it quits. Raoul draws a parallel to the 2017 double pump, where Bitcoin prices pulled back 45% after setting a new all-time high before exploding another 2,000%.
By end November, Bitcoin's value had grown 10 times from the start of the year. And then less than 2 weeks later, it almost doubled again.
He is joined by Jamie Coutts, and they make a strong case for why this dip and the many like it are likely nothing to worry about. Let's jump right in.
So the market structures definitely change. It changes every single cycle. There's a new cohort that comes in. So there is institutions involved in this cycle. You can see it in the median transaction value of Bitcoin transfers. So it reached a disastrously low median price of transfer level around 7 or 8 months ago. It was around $10. Now that's gone up to 300. It's just one measure. Transfer values and the on-chain data is clear. Some of the buyers of the ETFs are institutions. BlackRock and Fidelity themselves are allocating some of their other ETFs, their multi-asset ETFs, into this product, which was always the long-term game plan. And so I think a lot of institutions are doing the same thing. They're thinking about it as the new asset class. I certainly think that is the case. Digital assets in a whole, and I would bucket that, Bitcoin and everything else. But some of the allocations are going into long-term multi-asset type portfolios, which will have an impact, a very differing impact on the cycles, because the way that they treat those allocations, the way they rebalance based on performance will change, potentially smooth some of the volatility over the long term. But there's still retail there. There's still the same sort of FOMO activity that we've seen in previous cycles. But I don't think you can say that this is the same as every other cycle. It's changed.
The RIAs do the same kind of thing. It's like they just often will say to their clients, we'll put 1% of your portfolio in discretionary stuff. So that changes. I think they all are aware how volatile this is. It's been sold to them as a volatile asset, and this is a long-term thing. My guess is there's more long-term holders. Later, you'll get the FOMO retail of everybody trying to do this. But right now, this is a lot of people like Bitwise, Fidelity, Franklin, everybody going to their client base, talking them through it, explaining it. This is more thoughtful allocation. The other thing that people haven't realized is you can now put it in your 401k. So the average millennial who's a buyer of the NASDAQ or the S&P 500 passive index products will buy this, and they'll buy it every 2 weeks with their paycheck. And so we will see a difference in the structure of flows, as Jamie's alluding to. It's just going to change. Probably means it's less volatile on the down cycle. It also could cause a full bubble on the up cycle this time around because you've got numerous new participants who could enter. And, this is a limited supply asset and 80% of it's hoarded. So it can get pretty tricky. So I don't know how it plays out. I know a lot of purists don't like it because it's an ETF and not people opening wallets and self-custody. I actually think of it as a Trojan horse where we're actually teaching people about this product. Before you know it, they understand why they're buying it and they come into crypto land. So I think it's relatively good quality holders. Also, Hunter Horsley hinted that I think it's on the quarterly statements. You'll see who the big holders of the ETFs are. And he hinted that you'll be surprised who's on the list.
Bitwise, right, Hunter?
Bitwise, yeah.
Yeah, I've got this suspicion too, Maggie, that we've already started to see accumulation by institutions at a sovereign level, whether that's the sovereign wealth funds, the pensions, potentially nation states. You've got mining operations now in several countries around the world where the countries themselves have co-invested with private mining companies. So, and these are countries that are sort of typically energy rich and significant players within the energy markets. And I think they see the world very differently to Europe or the United States or Western countries. I don't think we'll see any major announcements in the short term. I just think that my working hypothesis is that they're accumulating. They've got access to virgin Bitcoin through the mining operations. If they foresee a world in which Bitcoin does become significant, they can avoid one of the major steps in disclosing and showing their cards by going to a BlackRock, going to a Coinbase to acquire coins. They have access to virgin coins domestically. So it's another sign for me that the game has changed.
The ETFs have changed the Bitcoin game, and contrary to what you might be led to believe due to the recent drop in hype, the ETFs are still making waves for institutional adoption. But even beyond these ETFs, Jamie has revealed that mining is another gateway that even nation-states like Bhutan are taking to enter into Bitcoin. All of this while BlackRock and Fidelity themselves are yet to make any real commitment into the ETFs. One can only speculate on the full impact when institutions are fully here. Raoul thinks the ETFs could be responsible for a super bubble cycle, and he discusses more on that next.
What kind of cycle do you think it's going to be? Because I've been trying to wrestle with the odds between a left translated short cycle, a regular cycle, or something a bit more wild. That's kind of part of this, where you think we are in the cycle stuff. What is your view?
I'll give a non-answer. I think the way that you've thought about this, Raoul, is the correct way. You can assign probabilities to it. And I think you've thought about it through, so I'm not in the camp of the 250,000, but I'm with you, Raoul. There's a probability that it will.
The one that scares me is the short cycle, the kind of slightly stunted. I think that was the last cycle was like that. And I think we all have PTSD, so we can deal with that one. If they take away the punch bowl a bit early, we can kind of deal with it because most people are sort of expecting it. A relatively normal cycle, I think people are fine with. My fear is the 2013 double pump. That's terrifying because that was what, a 45% correction mid bull market. Everybody thought it peaked because it had already done 10x or 20x or 30x, whatever the stupid number was. And then it did like another 20x from that point.
It was a V, wasn't it? I mean, it didn't even bottom out. I mean, it didn't even sort of flatline out.
The 2017 cycle, which Raoul accidentally refers to as 2013, was one of the most vicious because of the double top phenomena Raoul discussed. During this cycle, after setting an all-time high, Bitcoin corrected a massive 45%, and many said the cycle was over. Ethereum ended up doing another 20x from this point, much to the shock of everyone. Raoul believes there's a possibility we get a repeat of that this cycle, and even though he encourages considering more conservative and even left-tail possibilities, he's confident that the gains have just begun. Sit back as we bring you more clips from the interview.
We should expect 30 to 40% pullbacks in a bull market where we've seen 150% appreciation in just the last 12 months. So it's been a little bit unusual, and that's really the structural buyer of the ETFs that's smoothed things out. I follow the derivatives markets really closely, perhaps more closely than I should, given I have just got scar tissue from the last cycle, because that was really what brought the markets undone eventually in Bitcoin. I still think they're going to play a major role. I'm watching it just for the earliest signs that we're starting to see the build-up of concerning leverage and sort of behavior that is toppy in nature. And, you still see very high open interest, but the funding rates have come down. Now, the funding rates are still elevated. So we do need a reset. We need some of the open interest interest to go away. We need funding rates to get somewhere back to neutral. But it could very well be that they stay a little bit more elevated because we've got the perception ETFs are there, they're buying every day at 3 to 5 times the supply. I'm fine, I can take this leverage, and that sort of builds in risks over the long term. But to your point, Maggie, like, yeah, we could pull back a little bit further, but I think, we're sort of at the halfway point in the cycle.
My view hasn't changed. I've been long risk since November 2022, long crypto, long tech, and just haven't changed that. And it's been stupidly good. I just kind of left my brain behind and said, look, liquidity goes up over time, over the business cycle. These are the assets to own, and it works incredibly. We've got these mega trends. Just ride them. Everyone overthinks it, over worries, short-term trades it. Meanwhile, it's printing generational wealth, not only in crypto, but in tech as well. So just don't overthink it. Tomorrow will be more digital than today. So therefore, that's the secular trend. And the business cycle, we've only just bottomed in the ISM or bottoming. So we haven't even got anywhere. So there's nothing to worry about. Of course, you will have volatility. And the other thing is you've got seasonality of election years, basically up only with, one big wiggle somewhere in the summer. Generally, I don't see anything to worry about. Yeah, I mean, even if we go to war with somebody, they're just going to print more money and then just rise the price up. I just don't have anything to worry about.
We have absolutely nothing to worry about. It's crypto summer, it's macro summer, and all the stars have aligned. All we need to do is, as Raoul often says, not this up by using leverage or trying to time it. Raoul implores that we simply buy, hold, and anticipate the magnificent price pumps. What do you think about Raoul's bullishness, and what type of cycle do you predict? To see the latest in crypto news, watch this video here.